Episode number 2 of the Insurance Awareness series by Mr. Deepak Godbole. Risk management, risk types, peril and hazard. An insurance risk is a threat or a peril that the insurance company has agreed to insure against in the policy wordings. Risk is the probability that an event could occur that causes a loss. For an insurance company, risk will determine whether or not they may have to pay a claim. Estimation of the amount of loss due to the perceived risk being underwritten by an insurer will be used by the underwriter to decide whether or not the risk should be written. If the answer is in affirmative, the amount of premium to be charged to the insured to cover the specific insurance risks need to be determined. Financial risks are those in which the outcome of a loss can be measured monetarily. Pure risk, also referred to as absolute risk, is the potential for a loss to occur but without any corresponding potential for gain. Speculative risk, on the other hand, is the potential for either a gain or a loss to occur. Fundamental risk is related to events that usually arise from nature and cannot be controlled by any individual or group. Such risks include floods, earthquakes, tsunamis, hurricanes, tornadoes, cyclones, volcanic eruptions, drought, and other natural disasters. Particular risk, on the other hand, relates to events that occur because of individual or group behavior. Factors for calculating premium are: event occurrence. If the chance of occurrence of the particular event is high, then the premium will be more and vice versa. Level of damage. If the level or severity of the resultant damage or loss is expected to be very high, then the insurance company will charge higher premium. Amount or value of risks. If the insurance company covers more perils or events, the insurance will be more expensive. Risk management is not about the elimination of risk. Risk can benefit businesses by creating productive opportunities. Techniques of risk management: risk avoidance, risk reduction, risk transfer and risk retention. Risk avoidance means withdrawing from a risk scenario or deciding not to participate. The risk reduction technique is applied to keep risk to an acceptable level and reduce the severity of loss through. Transfer of risk refers to a business agreement where one party pays money to another party to mitigate specific losses that may or may not occur. This is the base of the insurance industry. When risk is agreed, accepted, and accounted for in budgeting, it is a retained risk. The risk management techniques ensure that all risk scenarios are covered by a protocol that is appropriate and effective. The word risk simply refers to the possibility of a loss. Perils and hazards aren't synonyms. A peril is the cause of the loss, and a hazard increases the likelihood of a peril happening. Hazard is a condition. There are three types of hazards: physical, moral and moral. In essence, relationship between risk, peril, and hazard is like this. A risk is the potential for a loss, a peril is the cause of a loss, and hazard is something that increases the likelihood of a loss. More information would be available in other episodes of this risk management and insurance awareness initiative by Mr. Deepak Godbole.